Welcome to the Wealth Matters podcast, where investors come together to better understand how to build passive cash flow and create generational wealth without all the confusing mumbo-jumbo. Here's your host and co-author of Amazon #1 bestseller, Alpesh Pamar.
Welcome to Wealth Matters podcast. Hope everyone had a nice July 4th break. Of course, we are recording this right after July 4th, but this episode would be published most probably in about 2 months. So I'm going to interview Mr. Drew Breneman today. He's a natural-born entrepreneur. Drew started his first business at 14. He then launched a highly successful internet business while in high school. That's amazing. I didn't even know B of business in high school. So that's kudos to you, man. So his ambition for finding the best investment vehicle for his earnings from his internet business is what led him to real estate, purchasing his first 2 rental properties at 19 years old. So this is amazing. And also Drew earned his BBA in real estate and urban land economics from the University of Wisconsin, Madison's Wisconsin School of Business. So this is amazing as well. So welcome, Drew, to Wealth Matters Podcast.
Thanks, Alpesh. Appreciate it. Thanks for having me. Really like the show. I'm happy to be on it.
Thank you. So we start with this question. Of course, I went through your bio. Amazing. When 19-year-old started investing in real estate. But leaving aside all that, tell us something interesting or funny about yourself.
Yeah, well, one thing that's real estate has allowed me to do is to travel like some pretty cool places. These weren't part of the real estate deals, but just something when you achieve financial freedom that you can do is you can go on the trips that you want. And right. In the year after I quit my full-time job, and I already had 10 properties at that point, either on my own or with a partner. And I was going to count before we started this, but I ran out of time, but I believe the number was 14 countries in that year following. And so I went to a lot of cool United Arab Emirates, India, Japan, China, Hong Kong, Macau, Singapore, Philippines, all over Europe, so I was able to do a lot of, and I've still done that. I'm actually going to Hawaii on Wednesday this week, and then was in Europe a couple months ago. But yeah, that's not on the bio, like maybe the hobbies. But that's been my #1 sort of, how do I, enjoy myself, enjoy my time, definitely travel, and then traveling to, new countries really. So.
No, that is amazing. So, of course, I figured out that you started investing back when you were 19. So what was your very first investment and how did it work out for you?
Yeah, the first property that I bought was you're talking about first real estate investment or first just anything, or?
Yeah, I would say first specific? Any investment.
Yeah, I mean, the first investment that I made was not real estate. It was I had started that internet business like you had mentioned, and I saved all the money from that business, and I started looking at what could I invest it in, and I did sort of what everybody starts out doing. I invested in the stock market. Yes. My parents are both teachers, so they have pensions, but what extra money they did save, they did invest in mutual funds. And so I invested in the same mutual funds that my dad was, essentially. And, and sort of just got whatever those made. And I believe it was, like a flat to down market. I remember thinking this isn't too exciting. And I kept educating myself and seeing what else is out there. And then stumbled into real estate, so to speak, and really liked what I saw. And then eventually did my own deal when I went to college.
Oh, that's great. So what are you currently focused on real estate side?
Yeah, so today I have a $200 million portfolio of primarily multifamily assets in the Midwest. But 2 years ago, we made a shift in the business where most of those deals I bought with just 2 investors, and they were all in the Midwest. But then in 2021, we shifted to the Sun Belt. So every deal we've bought since then has been in the Sun Belt. They were all in Phoenix. And then I've also opened up the business to passive investors, because kind of over that 15-year period, I was working just with these 2 investors. I'd have people that wanted to invest, but I wasn't really set up to take on any additional investors. So we've done that. And, got going in Phoenix. I live in Texas now, so the next markets up are Dallas and Austin. So
That's great. So, before the podcast, we were chatting about what your focus is in even multifamily real estate side, and you mentioned newer properties. Why do you prefer to buy newer properties?
yeah, I think a lot of people, they think like newer is it more expensive or you make less on them. And that has not been my experience. I understand like the price just in, let's say, total dollars for an older property. Yeah, it's usually less than a newer one, all things
Right,
being
of
equal.
course.
But also the income is a lot less on an older building. The rents are lower. The operating expenses usually as
Expenses
a
are high.
percentage of the rents are, if we're talking in the Midwest, you might have a boiler where you're paying all this money for heat, or down in the South, you got a boiler chiller and you're
Chiller,
paying
yeah.
to cool all the, to cool all the water to make the air conditioning. So really, so it comes down more to, kind of minimizing variables. And what I've saw on the older buildings we bought, and we've still bought a number of older buildings that we bought and renovated or done something to, but we've done just as well financially on the newer ones we bought doing lighter renovations. So I wouldn't say like it's just you just make more on the older, less nice stuff, and you end up with more, typically more issues you need to figure out. Like let's say you bought a building built in the 1960s, in these markets that we cover, in Arizona or Texas, if they have not replaced the plumbing, so the water supply pipes or the drains or the sewers, I mean, that stuff has already reached its useful life. So you are on borrowed time, or you're going to have sewer breaks, drains within the building crack. You have these old galvanized pipes where they're rusting from the inside. You have bad water pressure, and you're just kind of on borrowed time with those things. Eventually, someone's going to need to replace them. And if it's not you spending all the money on it, like the next buyer is going to factor that in, and you're not going to get as much of a a pop in value potentially if they notice these issues. So sometimes, we're sure when the market's so hot, people throw caution to the wind and they don't
Right.
look into any of that stuff, or their earnest money is already non-refundable. But market's not always just on fire like it was in 2021. In a normal market,
Yes.
people inspect the building and they think about all these things. So I mean, that's what I would say.
That's great. So, and when you say newer properties, do you look for, how do you identify them? Is it year 2000 and after? Is there any criteria?
Yeah, I think so. We're value add buyers, and so I kind of put it into two, I'd say three buckets of types of deals we're looking at. If you were talking ages, so you'd have the deals that maybe, let's say, would be built from 1990 to now. Those are all built with modern plumbing, electric, roofing materials. So you're not going to
Right.
run into what I talked about, where your drains are going to be, cast iron, and your sewer in the ground be clay or something, and you don't have the galvanized pipes. You're dealing with copper or PEX on the plumbing. You're dealing with ABS or PVC on the drains and sewer lines. So you're already starting with where you don't have to deal with any of these major capex headaches. And then the what value add we're it depends on the asset. Sometimes you can go in there and you can renovate the kitchens and bathrooms, or swap out the appliances with stainless steel ones. Or other times, and honestly, the deals that we've done probably the best with, when I was buying a lot in Chicago, because from 2013 to 2019, I did 15 full cash out refinances of all the equity we put into deals. And meaning, let's say we bought a deal for 5 million, we put 1 million down, we made it worth 6 million or more, then put a new loan on it that was $1 million or more of loan amount, loan proceeds, and then at closing to the refinance, that money just goes to you. You borrowed more. It's not a taxable event, and then we would then repeat the process. And out of those 15 deals, I think only 2 or 3 of them required any meaningful amount of construction. The rest were all operational value add plays, meaning we bought a building that was 1 year old from a developer, but he rented it out in the winter when the rental market is really depressed, and he's 20% below market on rents. So yeah, I would prefer to buy those kind of buildings all day versus the other types we still do buy. If I could buy a 1-year-old building and then just next summer raise the rents 10, 15, 20%, that's my favorite deal. And then
Right.
my next favorite would be buy something that was built in the 1980s, let's say, where it feels old, but it at least still has those modern like building systems talking about, where about in the 1980s they started switching over to using copper for the plumbing and using PVC or ABS. It's just PVC ABS is the same thing. It's the plastic piping for the
Right.
drains and sewer. People just seem to use the different terms depending on where you are. So, but they and so like that type of property we also buy, but then typically it's a heavier value add where there is not in-unit laundry in it, and the cabinets are not nice, the counters are they're not quartz or granite. So we're doing a much bigger renovation there. We're adding in-unit laundry, we're renovating the exterior, we're painting the building, we're painting the cabinets, putting new door fronts on, doing the bathrooms, new floor, like doing a full unit, but not a gut rehab per se, but we're still spending, a lot of money, a 20,000 a door type thing, 15 to 20. And then the third type, yeah, you're buying an older one, you're doing a full gut rehab where you realize, okay, these building systems are old. We're going to need to be the one who is going to need to replace the electric that's aluminum, or this old plumbing. And so I've only taken on one building like that so far, and then that was in Chicago and built it like in 1900. So it was but that was still a really good deal financially. So you just got to know what you're getting yourself into. But if you'd say, would you like to buy newer or older? I mean, if you can get even close to the same returns on a newer building as an older one, like why take the risk buying an older building and having all these extra what ifs? Okay, we buy this building built in 1960, you own it for 3 months and then your sewer breaks. That's happened to me. I've had
Yeah.
more than 5 sewer breaks at this point. Some of them we knew when we bought, we cambered the lines when we were buying it. We saw it was broken. We got a credit. But yeah, if I had to guess, probably the number, it's more than 5, maybe 8 at this point. But in some of them, it's because we bought, we've owned them for 10 years and then it happened later on down the line. But that's stuff you could have somewhat predicted going, yeah, you're buying a 100-year-old renovated building in Chicago. But they didn't switch the sewer out to the street, and then sure enough, you break somewhere in your yard and you're replacing it. Where on a new building, you got a new pipe there. So
right. So and I think you kind of spoke about this, but again, I still have the same questions. Aren't newer properties expensive compared to older buildings, and how do you keep that in mind while underwriting?
yeah, I mean, yeah, I think they're more expensive in total dollars, I think is why probably you're asking the question. But
Right.
the rents are higher. The expenses as a percentage of those rents typically are lower because you're not paying most of the utilities like you might be in an older one. Less things are breaking. When they do break, maybe they're more money to replace because it's newer and nicer. But no, they're not. I don't think they're more expensive. I think if anything, they could be cheaper relative to the income because you're dealing with less unknowns. But even if they are more in total dollars, your net operating income for that unit or for that property is going to be high relative to the price you're paying. So
Got it. And another question I have is, how do you, because you, of course, in multifamily world or any real estate world, we try to do some kind of value add to increase value, right? How do you increase rents or perform value add in newer buildings? Because older buildings, we know, you can pretty much rehab the heck out of it, make it look nicer, newer, better, maybe put new park and whatnot. But newer buildings may have some of those amenities.
Yeah. And so on those buildings, a lot of times it's more operational, meaning it's like the deal from the developer I'm talking about where he rented all the units at the same time in December and January, and all in your value add is your redo, when those leases come up for renewal, you're offering 18-month and 6-month renewals so they can end in the prime leasing
Summer,
season.
yes.
And then when they come around the next time, now you're taking full advantage of the summer rents, not the winter rents. And in a lot of these markets where it's seasonal, that could be a 10 or 20% difference. Because like, who wants to move around the holidays, and especially not in the Midwest when it's also snowing and super cold and all freezing when you're moving. But yeah, so that's one. And then two, even buildings that are like 5 years old, some of them, let's say 5 or 10 years old, there's still things you can do physically. It's not like you're saying where you need to reprogram all the amenities and do a lot. It might be, though, the whole building was painted just a flat white paint that doesn't look very good, and you could come in there and you can paint the walls a nice light gray, and then already some of the light fixtures might look old. It was like the builder track lighting. You can put in nicer lighting. I'm thinking of one deal we bought where it was renovated in the 90s, and all we did, and we ended up raising the rents over 20%. It was like part operational, like I'm talking about, where he could have just charged more but didn't. So we did that. Plus we also got rid of all the carpeting in the building, replaced it with vinyl in the bedrooms, and then in the kitchens they had, I forgot which, white or black appliances, and we switched it out with stainless steel. And then in the rear of the property, this was actually just a 5-unit in Chicago, but in Chicago that goes pretty far. It was a $2 million purchase. And then
Wow.
and then we redid the 2 kitchens in the coach house in the back building, because they were just really cheap laminate counters, just cheap cabinets. So we did a full replacement of the cabinets, the boxes, and the countertop, put in a quartz one, and stainless steel appliances. And that's in an area where like rents are very high, where our 4-bedroom unit, it's a 2-floor duplex, it rents for like $4,700 now. So it's something where when we bought it, it was renting for 3,000 something. We got the finishes more to like a 2,000 at the time, like 20 standard, and then grew the rents like $1,000 a unit. So
that's awesome. Now it makes sense.
yeah.
So let's talk about your journey. What are some of the mistakes you have made?
Yeah, I mean, I think, kind of early on, I never thought about getting investors. Like that sort of, the first 4 deals I bought were just all with my own money. And then I didn't really know what was the next move to make. And so I got a full-time job. Unfortunately, while I was working there, I met my first 2 partners. And then the 3 of us bought $100 million of property together. But I didn't go out and like sort of seek that out. I just sort of told my story to everyone, what I'm up to. I met with them. I had deals printed out ready to pitch, and I did, but I didn't do that like proactively. And I never really did until recently. And so, I just sort of worked with them. And then another family eventually, since I started essentially. So I would say I should have been more proactive about, trying to grow a company and trying to obtain investors. I never really did anything. If we're talking about like other mistakes along the way, I mean, the only mistake that I think that like jumps out that we're like, oh wow, that was a big mess up, is we bought one office building. And that wasn't the mistake, actually. I guess you could say maybe that would be as well. But the office building investment went well. But when we were doing a lease renewal, office leases have this like a common area load factor that's added on. So let's say you sign a lease for a 10,000 square feet. That's what you're actually getting. You don't sign the lease for 10,000 square feet. You sign it for like 10,000 square feet plus this common area load factor. So if, let's say, the common areas of the building are 20% of the whole building, you actually sign a lease for 12,000 square feet. Well, I never knew that. 10,000, times 20, added together, 20%. I didn't know that. So we just renewed them at like whatever their square footage was, 10,000. And then we realized, wait, we just kind of lost some square footage. And I'm saying it's a renewal. They expanded into a different part of the building, but it wasn't the exact amount of space that we got back some space. We rented part of it to them. We measured it differently. So then we lost some square footage in the building. And we were able to explain to them, here's what happened. And then when they wanted sort of something from us, if you will, to update their lease, we said, that's fine, but we need to fix this square footage now. So that didn't end up really costing us much, but just kind of, goes back to kind of, makes me think about like why people should specialize. At that point I had bought probably 4 multifamily deals, 4 shopping centers, 1 office building, 1 industrial deal. This is kind of like a generalist, just whatever was a good deal. That's what I was doing. And then from 2013, let's say till now, every deal but 2 has been 2 or 3 has been multifamily, and every deal since 2019 has been multifamily. So we, just started specializing and having better results from that as well. So
that makes sense. What has been your best deal so far?
Yeah, it's the deal that I like the most is actually what ended up happening with the office building when we sold it. Because what on a single deal, it wouldn't be this one, but I like how it worked, and I like to talk about investing long term, because so many people are just doing like kind of quick 2-3 year holds, almost like we own that office building for 5 years. We doubled our money. We put 930,000 down. So we turn that into, let's say, $1.8 million. Then we take what's equity we have from that. We did a 1031 into a shopping center that we bought for $7 million or so. We own that for about 5 years as well. Then we sold that. We doubled our money again on that deal. So now we turned, just to use round numbers, $1 million into 4 at this point. And then we went out and we bought 2 larger shopping centers, one for $8 million and one for $9 million. And that happened all over a 10-year period. And so what I like to think about is we actually took like one of our worst deals just as a single deal office building. And then through doing these 1031 exchanges, it actually ended up being our best sort of series of deals, because now on those 2 shopping centers we own now, the cash flow and the loan paid on those every year is almost 900,000 per year. And we put 930 down. So obviously this isn't the IRR or anything, but like if you just look as like simple person, like what's my annual return, we're making almost 100% per year on that money now, without even factoring in the appreciation, just cash flow and then paying the loan down. And so I like to that's an example I like to talk about, because I like to invest long term. And something I was thinking about incorporating in our future offerings to investors is actually just have the pitch be that like we're going to invest in one deal, and then the plan is it's going to be a 3 or 5 year hold. Then we're going to sell it. We're going to do another one. So let's say we double the money in 5 years. We're going to do another one, and it turns into a 4x over 10 years. 4x return on your money, doing 2 times where you double it. If you put $1 million in, turns into 2, then 2 turns into 4. Versus just doing all these, one-off kind of 5 year hold value add deals, where then you don't need to do anything. You don't pay any taxes yet. We'll 1031 into the next deal, or do a cash out refi, buy they'll keep the first one. So I've been trying to, figure out how can we incorporate that in every deal we do and turn it into like a longer series of deals. So.
Got it. No, that makes sense. And what has been your worst deal so far?
I think the second deal I bought was this. So I bought 4 properties when I was in Madison. I think that's probably was my worst one, where it was one of the few deals I bought where it had no value add. So the main reason I bought it was because I had like just enough money at that point to buy it. Like it was a good relative purchase by a gross and multiplier basis, and I had enough money where I could buy something around 350,000 for my second deal. And so like that was my thesis. I can invest all this cash I have, and then it's a good relative purchase. But the other 3 deals I did in Madison, and most all the other deals that I bought since, they all had some way where I was adding value. So I'd say that was my worst deal. I still made money on it, but I just made whatever the Madison, market made in that time period. But so one thing that I'd always recommend to people is you want to find deals that have value add, and be not paying up for that value add in a big way, where you want to buy based on what's there today and then add value. So you'll create value, plus you'll get what the market return is. So kind of insulate yourself if there's a pullback or anything as well.
Right. Is now a good time to invest in real estate?
I mean, it's time where you need to be careful. So I guess almost in a way, it depends for who. If you're just getting started, I would say for sure it is, because it's going to take a while to buy your first deal. You're going to learn so much on that first deal. I'd say, yeah, you need to get your learning out of the way and just get going. And, if prices drop over the next year, like then your second deal is going to be a better deal than your first one. If you don't need to do any learning and you kind of already, whatever, have obtained the education you need from the school of hard knocks, then I think, yeah, it's still a good time to buy. You just have to be really careful, because right now, at least in the multifamily deals we look at, the sale transaction volume is down a lot. It's down between
Yes.
50 to 80%. So what's going on is the properties that do sell, relative to what the returns are on those deals, for the new buyer, they're still selling at where people are accepting pretty low returns. So it's a discount to a year and a half ago. Yeah, prices on multifamily, depending on where in the country, are down anywhere from 5 to 30%. But with how high interest rates are and rent growth flattening out, and it's even buying maybe at a 20% discount to a year and a half ago, the deal still doesn't look that great if your interest rate is going to be 6 or 7%. So I still think it's always a good time to buy. I would say it just depends what are you paying and how long's your hold period. If you're the highest bidder on a deal where there was 30 other offers and you're trying to own that for 3 years, no, that sounds horrible.
Yeah.
That sounds like you're paying the highest price and your hold period so short. Who knows what's
Right.
2026 is going to look like. But if let's say you bought it and there's only one other bidder and your prices sounds pretty good and you're going to own it for 10 years, yeah, I would bet all my money that real estate is worth more in 2033 than in 2023. So,
Oh, that's great. No, this was awesome. Thank you so much for sharing all the golden nuggets. Are you ready for fire round?
yeah, let's do it.
Would you be changing a business or investment strategy because of the current environment where inflation is still high and we all think that either recession is here or it's around the corner?
Yeah, what we've done is we're extending those hold periods like I'm talking about. Maybe 2 years ago, we would have been okay doing the hold, do our value add, just plan on selling it right away. We're not doing that. Now we're doing value add deals, but we would say this is a 5 or a 7 year type deal. Where I think, yeah, we wanted to extend our hold period and then not take on as risky of deals, like try to minimize variables. So buy in better locations, better properties, ideally newer ones if we can. So that's what we're doing.
That makes sense. What is your favorite non-fiction book? It could be real estate, self-development, business.
Yeah, I mean, the book that I always talk about is called Investing in Real Estate by Gary Eldred. So
Okay.
I guess that I'll give that one, because that was the book that got the light bulb going off in my head about real estate. So
Okay, I'm gonna check it out. I was taking a note.
yeah,
Any
it's really set up for beginners. So I think at
right.
this point, Alpesh, it's you might not learn much in that,
Yeah.
but when as a what would I have been as a
When you're
16-year-old
starting
trying to
out,
figure out,
yes,
yeah. So anyways, yeah.
that's great. Any tool or website you recommend or you cannot live without?
Yeah, I think if people can afford it, like CoStar is such a powerful
Oh,
tool. They have
yes.
all the properties for sale, market data. I mean, all that is so I definitely would say that. Otherwise, obviously Microsoft Excel, and this whole Google suite of tools, that's we run our whole business basically on that. So
Yeah. Any advice for real estate investors?
yeah, I think it's a make money slow, long-term kind of business. So I have found more success myself. And when I look around at other people that are successful investing long term and keeping things simple. So I know, a lot of people like to wholesale deals or do, flip houses and all that. But for me, long term investing and kind of with a relatively simple business plan where we're not doing anything too complicated. We're buying apartments and adding value and, sometimes sitting on them, refinance, sometimes selling them. So my advice is like a lot of especially these families you see that made so much money in real estate, they just bought properties in, New York or
Forever.
Chicago, and
Hell,
they bought them 40 years ago when they were, 100 grand, and
yep,
now they're 2
yep.
million. Like, it's kind of simple. So don't,
Right.
sometimes just embrace that.
I agree. How do you give back?
Yeah, right now, I mean, if to the real estate world, through my podcast, I've been trying to. My parents are both teachers, so I've been trying to do more to help educate people about real estate and just kind of offer something where it's not like there's no course or anything. It's just free to listen to the podcast. I'd like to do more of actual giving back, where but I haven't found the time. I also have a 5-year-old son, so he's got me
Yes.
every free second of daddy right now.
Yeah.
So but I would like to do more. I remember when I was in high school, I went to or grade school. I mean, I went to a Catholic grade school, and we were doing great stuff. Like we'd go work at like a food pantry, or people were going on mission trips, and so it'd be nice to start doing something like that. But it's hard to make the time for it. So
I agree. I know how hard it is to raise kids. How can my listeners reach out to you?
Yeah, I'm on social media on every platform now. Even signed up for TikTok, took the jump on that. My sister works in social media, so she's like, "You got to get on TikTok." But anyways,
Yes.
I'm at every platform at Drew Breneman. And then if you want to learn about our company, Breneman Capital, you can go to breneman.com. We have information on our portfolio there. We have our blog. You can sign up to be a passive investor. We have a passive investing guidebook you can download. It's 100 pages, teaches you everything you need to know about looking at these real estate syndication deals, or what to look for in a real estate deal, and all the different terminology. And then obviously my podcast, the Breneman Blueprint, which is just on all the podcast platforms and on YouTube. So appreciate you having me on, Alpesh. This was fun.
Absolutely, man. I had a lot of fun. And of course, as in every podcast, I learned a lot. Thank you.
Thank you.
Thanks for listening to the Wealth Matters podcast. If you enjoyed it, please leave us a 5-star rating on iTunes so others can enjoy the show too. Have a great week and happy investing!